Greetings, everyone. I'm David Darst, here to give you a brief recap of the month of December 2024 and how quickly this year has sped by. During the month, we had a number of important developments affecting financial asset prices. You have to start off with the new President-elect Trump talking about imposing 25% tariffs on Canadian and Mexican imports and adding a supplemental tariff of 10% on Chinese imports. Now, these are just rhetorical devices at this point. Obviously, a lot of things have to happen between now and early January 20th, which will be the inauguration. You had the November jobs numbers released on December the 6th, earlier this month. They were up 227,000. The two previous months were revised upward by 56,000. Unemployment came in at 4.2%, up 0.1% from 4.1% for the month previous. Average hourly earnings up 0.4% and 4.0% year over year. So strength in the labor market, strength in the wage income to workers. There was a comment by President-elect Trump that he has, quote, no plans to replace Jay Powell, close quote. That definitely, I think, calmed markets somewhat because they were wondering whether there would be some sort of a Fed administration fight that would start out in the new administration. Broadcom went up 25% in one of the weeks of this month. 25%, basically closing in on almost $1 trillion market cap. This is part of the artificial intelligence enthusiasm, which waxed and waned. It means it grew and it eased back. The third quarter GDP final number came in 3.1%. Again, strength, economic resilience continues. The fourth quarter, as of right now, as of here at the end of December, the fourth quarter estimate of the Atlanta Federal Reserve, the GDP Now forecasting tool, also 3.1%. Late in the month, you had the personal consumption expenditures price index, and that was up 0.1% on a headline basis, 2.4% year over year headline. And the core, which strips out food and energy, as you know, up 0.1%, and it was up 2.8%, which was a little bit to the warm side. Then you had the Federal Open Market Committee, and this is one of the things that is the reason that the month has turned out as it did. The Federal Open Market Committee, they did reduce interest rates by 25 basis points. And by the way, that's a total of 100 basis point reduction since September the 18th, when they started cutting rates. They had 3 rate decreases totaling 100 basis points. And interestingly enough, 10-year Treasury bonds, the yields, rather than going down, have actually gone up by 80 basis points. So this has many money managers and investors and the public at large scratching their heads, wondering about inflation. What's the inflation outlook? Fed funds futures markets here at the end of December are pricing in only 2 interest rate cuts for the coming year, for 2025. The language, you could look at some of the language that was in the statement that the Fed released, and there's a possibility of maybe none. So you got a 50-50 chance of 2 cuts or no cuts this coming year. The summary of economic projections, you know, they release those 4 times a year. Excuse me. The core for the personal consumption expenditures expected to be 2.5% at the end of next year. Remember, it's 2.8% now, so that would be only a decline of 0.3%. Not that much of a decline in inflation. And you have unemployment expected to go up to 4.3% versus 4.2% now. So again, strength and continuing inflation. So does the Fed need to cut interest rates? This is really question number 1 on many investors' minds. You did have at the end of the month a stopgap legislation. The House of Representatives voted, the Senate voted, and the president signed stopgap legislation to avoid a government shutdown. Cutting through all of this, the S&P closed for the month at 5930.85, and that means it was down 1.7%, around that for the month, up 24.3% year to date. The Russell 2000, which is your small and mid cap, had a very tough month. It was down 7.5%, and it's up 10.6% for the year to date. The bank stocks down 7.6% for the month, up 32.5% year to date. Europe, year to date, up 4.8%. China, up 13.2%. And Japan, up 15.7% year to date. So, all in all, markets basically have had to kind of reposition themselves as far as the narrative. Economic growth remains strong. Fed inflation is stalled out here. Fed interest rate cuts, no longer 5 cuts this coming year. Maybe 2, maybe none. So that's really what people have been pricing in. The 2-year Treasury closed the month at 4.30%. It was up 17 basis points for the month. And again, the 10-year Treasury closed at 4.52%, and it was up 34 basis points for the month, and again, a total of 80 basis points since September 18th when the Fed began cutting. With interest rates rising, as you might imagine, gold was down 1.1% for the year. It's 28.8%, around 26.25 for the gold price in dollars per troy ounce. Oil, $69.46 to $70. It was up 2% for the month. It's down 3% for the year, around that here at the close of December. The dollar was up 2% for the month, and the U.S. dollar against the DXY currency is up 6.4% year to date. The volatility index closed the month at 18.31. It began the month at 13.51. So this volatility has gone up, as you can see, much more fluctuation built into equities prices. In terms of the month ahead of January, looking forward, you got a couple of you got the jobs numbers will come right here at the first week of January. You have January 28th, 29th is a 2-day Fed meeting. Right now, many people think the Fed will skip raising interest rates or cutting interest rates at no change at the January 28th, 29th meeting. The next meeting after that, go all the way out to March 18th, 19th, and then you've got May 6th, 7th. Those are the first 3 Fed meetings of the year. I would be remiss if I neglected to mention that Jensen Huang, he's the CEO of NVIDIA. He will be giving a big talk on January the 6th at the Consumer Electronics Show, CES, that takes place every January in Las Vegas, Nevada. And I think that people will be watching that very carefully. It's sort of a flagship for the artificial intelligence narrative. In terms of positioning, have some liquidity. We've had a big run up. Markets are very fully valued, public markets. We do believe credit deserves a place in the asset allocation, a mix of public credit as well as private credit. You basically, and pay attention to the maturity. Private credit is giving you a yield pickup versus public credit. It's worth it for the liquidity diminishment in order to grab that extra yield. Private equity, you want to basically be in secondaries and also with managers. We've been looking for sponsors who can take advantage of what is expected to be a whole slew of deregulation, what kinds of companies and sectors will be able to take advantage of deregulation, and also of possibly of tariffs, and also possibly of tax decreases. Let's conclude by reminding everyone, only 3 times in history has the Standard & Poor's gone up 20% back to back, which it has done thus far this year. 20% last year, over 20%, 20% this year. The first time that happened was back in the 1930s, 1935, 1936. But then 1937, there was fears of a recession and plunging back into a depression, and the S&P fell 37%. So that's the first instance. The second instance was in the 1950s, which was a golden era for stocks. Interest rates were low. Consumers were coming back to spend from the end of World War II. 1954, 1955, the S&P 500 went up 20% both years. But 1956, only up 2.6%. So the first two instances of plus 20% back-to-back, you had a big decline or else a very small gain. The third instance, this is amazing to me, 1995, 1996. So you had those 2 years back-to-back. Then you got 1997, 1998, and almost 1999. It came very close to a fifth year of 20% gains. And that was, of course, the internet. It was the dot-com boom, which was just an amazingly great run for U.S. equities. However, when the bill had to be paid in 2000, 2001, and it bottomed out down 50% from its peak. With that, we wish everyone a gloriously happy, successful, and prosperous new year, and look forward to catching up with you very soon in 2025.